Welcome to the deep dive. Today, we're going to be diving into Morgan Housel's The Psychology of Money. You've shared some really fascinating excerpts from it with us.
Yeah.
And we're not going to be talking about, which stocks to pick or anything like that,
Right.
but rather we'll be zeroing in on the often overlooked ways our brains work when it comes to money. Think of it like this. We're going to try and uncover how you think about money, not just what you do with it.
I think that's such a fascinating approach because it dives deep into the human side of finance, like our emotions, our biases, and even our personal stories.
Yeah.
All those things kind of add up and wind up influencing how we view wealth and risk.
Yeah, he throws down this really intriguing statement early on in the book. People do crazy things with money, but no one is crazy.
Okay.
I'm curious to hear your take on that. What do you think he means by that?
Well, it seems like he's getting at the idea that what one person might consider an irrational financial decision could actually make perfect sense to someone else. It all boils down to their unique set of experiences and circumstances. Our financial worldview is shaped by so many different things.
Hmm.
A combination of factors like how we were raised, the economic climate we grew up in, even just the stories we hear about money from our families.
So, for instance, someone who lived through a period of hyperinflation, they might be really hesitant to save money in traditional ways because they've seen firsthand how quickly money can lose its value, right?
Right.
Their experience could make them wary of banks, more inclined towards tangible assets like gold or real estate.
Yeah.
How do you think your personal experiences have influenced your own financial mindset?
Oh, that's a great question. It's something Housel really encourages us all to reflect on. Our past experiences create a sort of financial lens
Hmm.
through which we view the world. Like, for example, someone who witnessed the stock market crash of 1929, they might develop this deep aversion to risk, while someone who rode the tech boom of the 90s might be much more comfortable with volatility.
It's like we each carry around this invisible baggage of money memories,
Yeah,
both good and bad, and it colors how we approach financial decisions.
absolutely. And acknowledging those individual narratives is key to understanding why people sometimes make financial choices that, on the surface, seem illogical.
Like the example Households gives about the lottery paradox. He highlights how people in lower-income households often spend a disproportionate amount of their income on lottery tickets.
Right.
Logically, you'd think they'd be the most focused on saving every penny.
Yeah, you would think that. But,
Hmm.
but from their perspective, those lottery tickets represent a glimmer of hope, a chance to break free from their current financial struggles. Even though the odds of winning are incredibly slim, the dream itself
Yeah.
holds immense value.
It's a powerful illustration of how emotions and personal narratives can often trump logic in the realm of personal finance. It's easy to judge someone for spending their last dollar on a lottery ticket without fully understanding their situation and what that ticket symbolizes to them.
Yeah, and that kind of leads us to one of the book's central themes,
Okay.
the elusive concept of enough. Housel suggests that for many people, enough is this constantly shifting goalpost.
Ah.
They achieve a level of financial success, but instead of feeling content, they just raise the bar even higher, always striving for more.
And Housel drives this point home with the cautionary tales of individuals like Rajat Gupta and Bernie Madoff, who, despite amassing incredible wealth, still craved more, ultimately leading to their downfall. To me, their stories really underscore the danger of ambition outpacing satisfaction. When you're constantly fixated on what you don't have, you risk jeopardizing what you've already achieved.
Yeah, their stories really highlight the potential pitfalls
Yeah.
of that never enough mentality. It's like you're on this treadmill of escalating risk taking. The more you achieve, the more you feel you need, and the more risks you're willing to take to get there.
It's almost like a recipe for self-sabotage. So how do we escape this cycle? How do we define enough in a way that brings us contentment rather than constantly pushing us towards more? That's something I think we all struggle with.
That's the million-dollar question, isn't it? It's about finding that delicate balance between ambition and contentment, recognizing when you've reached a level of financial security that allows you to live a fulfilling life without constantly chasing the next big thing. It's different for everyone, of course, but it's a question worth pondering.
Definitely. Especially when we consider the power of compounding, which Housel emphasizes so vividly throughout the book. He uses some compelling examples like Warren Buffett, who began investing as a child. Buffett's incredible wealth is largely attributed to his incredibly long investing career. He's really a testament to the idea that time is the secret ingredient to building wealth.
Absolutely. And it's fascinating how Housel emphasizes that it's not just about starting early, but also about the consistency of returns over time. He uses this incredible hypothetical example of James Simons,
Okay.
who has achieved an astounding 66% annual return since 1988.
Wow. Imagine the staggering wealth Simons would have if he'd started investing just a decade or two earlier.
Right.
I mean, it really underscores how even small differences in returns,
Mm.
when compounded consistently over time, can lead to massive results.
You know, most of us tend to think about growth linearly, which makes it difficult to fully grasp the exponential power of compounding. We get excited about a 10% return on a stock, but we often underestimate the steady, predictable growth of something like a savings account. That compounds over decades.
It's about playing the long game, being patient, and letting the magic of compounding work its wonders. I feel like sometimes it's easy to get caught up in the excitement of those quick wins, lose sight of the bigger picture.
Right. We often focus on the immediate gains, the short-term fluctuations, without fully appreciating the long-term potential of slow and steady growth. But it's important to remember that getting wealthy is one thing. Keeping it is an entirely different challenge.
That reminds me of the contrast Housel draws between Jesse Livermore, a legendary stock trader who made and lost fortunes multiple times, and Abraham Germansky, a real estate developer who was wiped out in the 1929 crash.
I see.
Both men were incredibly successful at accumulating wealth, but they both ultimately lacked the discipline and resilience to preserve it. Livermore was known for his risky bets that ultimately led to his downfall, while Germansky was caught completely off guard by an unforeseen economic catastrophe. It makes you wonder what separates those who build lasting wealth from those who experience fleeting success.
That's a great question, and I think it's something we'll explore further as we continue our deep dive. What are your initial thoughts? What factors do you think contribute to long-term financial success?
Well, Housel seems to suggest that it's not just about earning money, but also about surviving financial shocks and avoiding ruin. It's about building a financial fortress that can withstand the inevitable ups and downs of the market and of life in general. He uses Warren Buffett as a prime example, highlighting his conservative approach and his focus on the long game.
I see.
Buffett is known for avoiding excessive debt, resisting the urge to panic sell during market downturns, and safeguarding his reputation. He's all about minimizing risk and making calculated decisions that prioritize long-term stability over short-term gains. In a way, it's about understanding that sometimes the best financial decision is simply not making a stupid one.
Exactly. It's about having a margin of safety,
Yeah.
understanding the risks you're taking, and recognizing that long-term success is often about avoiding catastrophic losses rather than chasing those quick, high-risk wins. So how does someone actually go about building that kind of resilience into their financial strategy? What are some practical steps they can take?
I'm glad you asked that because this leads us to another fascinating point Housel brings up, the concept of hidden wealth and the allure of material possessions. I'm curious, what was your experience like working as a valet? You've mentioned before that it provided you with some unique insights into people's relationship with money.
It was truly eye-opening. Working as a valet gave me a front row seat to this strange paradox.
Uh-huh.
The people driving the most expensive cars weren't always the wealthiest. In fact, some of them were stretching themselves incredibly thin just to maintain an image of affluence.
That really aligns with what Housel emphasizes.
Yeah.
True wealth is often invisible. It's not about the flashy purchases you make, but rather about the assets you've accumulated and the financial security you've built.
Right. There's this underlying psychological element at play, this desire to signal wealth to others, to gain admiration and respect.
Yeah.
But sometimes that pursuit of outward richness leads to spending that doesn't actually align with your financial goals or bring genuine happiness. It can even put your long-term financial security at risk.
It's like we get caught in this trap of equating spending with success, without recognizing that true wealth often lies in what you haven't spent. It's about the freedom and flexibility you create by delaying gratification and making thoughtful financial choices. It's about having the resources to pursue your passions, support the causes you believe in, and weather unexpected storms without derailing your financial stability. So what are your thoughts, listener? Are you pursuing outward richness or genuine financial security? Which one truly aligns with your values and aspirations? It really makes you think about what we prioritize, doesn't it? I mean, is it more important to look successful or actually be financially secure? It seems like a lot of people get caught up in chasing those outward signs of wealth without building a solid foundation.
Absolutely. And that brings us to another insightful concept Housel explores, the efficiency advantage. He makes a compelling argument that needing less can be just as impactful as earning more, and often it's something you have much more control over.
That reminds me of the example he uses about the 1970s oil crisis. Back then, it seemed like the world was on the brink of running out of oil. But that didn't actually happen.
Right.
What shifted?
It's interesting, right? We didn't solve the problem simply by discovering more oil. A huge part of the solution was becoming more efficient with how we used the energy we already had. We started building cars that were more fuel efficient, designing buildings that conserved energy, and adopting more sustainable practices overall.
So instead of just trying to increase the supply of oil, the focus shifted to decreasing the demand for it.
Exactly. And Housel suggests that we can apply the same principle to personal finance.
Okay.
Saving more can be just as powerful as earning more, and it's often a more reliable path to building wealth.
It's like taking control of your finances, rather than always chasing a bigger paycheck. What are your thoughts on that, listener? Have you ever found that focusing on reducing your needs had a positive impact on your finances?
It's a powerful shift in perspective. We often get caught up in the idea that earning more is the only way to improve our financial situation. But there's so much power in examining our spending habits and finding ways to be more efficient with our resources.
And Housel emphasizes that this is particularly important for those with modest incomes. Even if you can't afford to invest large sums of money right now, consistently setting aside a portion of your earnings can have a significant impact on your long-term financial well-being.
He really highlights the often overlooked power of the savings rate. Imagine two people both earning the same amount. One saves 5% of their income while the other saves 20%. Over time, that difference in savings rate will have a dramatic impact on their wealth.
It's about being intentional with your money, recognizing that small, consistent actions can add up to big results over time. It's not always about making drastic changes or hitting those lottery ticket wins. Sometimes it's those small, everyday choices that make the biggest difference.
And it challenges that traditional emphasis on income as the sole driver of wealth creation. Housel reminds us that we have more control over our spending than we often realize. And making conscious choices about our consumption can be a key to building lasting financial security.
But let's be real, it's not always about being perfectly rational with our money, right?
Yeah.
I mean, we're human beings with emotions.
Yeah.
And sometimes those emotions can lead us to make financial decisions that don't perfectly align with spreadsheets and logic.
Absolutely. Housel acknowledges that emotions play a huge role in our financial decisions. He shares this interesting anecdote about Harry Markowitz,
Okay.
a Nobel laureate who is considered a pioneer in the field of modern portfolio theory, which is all about rational decision-making and investing. But when it came to his own retirement investments, Markowitz admitted to making an emotional decision, not a purely rational one.
That makes me feel so much better. It's comforting to know that even brilliant economists like Markowitz are influenced by their emotions when it comes to money. It makes the whole thing feel a lot more relatable.
Exactly. We're not robots. We're emotional beings. And those emotions are bound to influence our financial choices, whether it's fear, greed, or even the desire to avoid regret. Our feelings can lead us down paths that might not perfectly align with traditional financial theory.
And I appreciate that Housel doesn't condemn those emotional impulses. He actually argues that it's okay to factor in feelings like regret, even if it doesn't make perfect sense, from a purely rational standpoint.
He recognizes that real-life financial decisions are often made in a social context. With all the accompanying pressures and biases, we might make a certain investment choice, not just because of the potential returns, but because we want to keep up with our peers or avoid feeling like we missed out on an opportunity. That fear of missing out, or FOMO as it's often called, can be a powerful motivator.
So how do we strike a balance? How do we acknowledge the role of emotions without letting them completely hijack our financial decision-making? It seems like finding that middle ground is key.
It's about being self-aware, recognizing our own emotional triggers, and understanding how they might be influencing our choices. It's about being honest with ourselves about our motivations and asking ourselves, is this decision driven by logic and a sound financial strategy? Or is it being fueled by fear, greed, or the need to impress others?
It's about bringing a sense of mindfulness to our financial decisions, isn't it? It's about pausing, reflecting, and making sure our choices align with our values and long-term goals.
Yeah.
But it's also important to avoid getting stuck in the trap of history, right? Hessel talks about how relying too heavily on past data can blind us to the ever-changing nature of financial markets.
He calls this the historians as prophets fallacy, assuming that the future of finance will simply be a continuation of the past. But the reality is markets are constantly evolving, innovating, and being shaped by unforeseen events. Think about how much the financial landscape has changed in just the past few decades.
He uses examples like the rise of index funds, the shift towards a service-based economy, and the changing demographics of investors. All of these factors have disrupted traditional investment strategies and created entirely new opportunities that wouldn't have been imaginable a generation ago.
Exactly. Clinging to outdated assumptions about how markets work can lead to missed opportunities and potentially disastrous investment decisions. It's like trying to navigate a bustling city. Using a map from 100 years ago, the landmarks might still be there, but the roads have changed, the traffic patterns are different, and there are entire neighborhoods that didn't even exist before.
So how do we navigate this ever-changing landscape without getting lost or falling behind? How do we make sure we're using the right map, so to speak?
It's about being adaptable, open to new information, and willing to adjust our financial strategies. As the world around us changes, it's about embracing a growth mindset, recognizing that there's always more to learn, and being open to challenging our own assumptions.
And I think a big part of that is recognizing that we can't predict the future with 100% certainty. There will always be unexpected events, market fluctuations, and unforeseen circumstances. That can throw us off course. That's why Housel stresses the importance of having room for error in our financial plans.
He argues that planning for the unexpected, both in life and in markets, is crucial to achieving long-term financial success. Whether it's a sudden job loss, an unexpected medical expense, or a market downturn, having a financial cushion can make all the difference.
He shares a cautionary tale about Rick Guerin, who was a close associate of Warren Buffett and Charlie Munger, but ultimately got wiped out in the 1973-74 market crash because he was overleveraged. He was forced to sell his Berkshire Hathaway stock at a fraction of his value to cover his debts. It's a stark reminder that even the smartest investors can get caught off guard by unforeseen circumstances.
Guerin's story highlights the dangers of taking on too much risk. Even if you make all the right moves, there's always a chance that something unexpected could happen. And having a margin of safety, a buffer to absorb those shocks, can be the difference between surviving a financial setback and being completely wiped out.
So how do we build in that room for error? Is it all about having a massive emergency fund, or is there more to it than that?
It's about having a multi-layered approach. Having a cash reserve for emergencies is absolutely crucial, but it's also about avoiding excessive debt, diversifying your investments, and being realistic about your financial goals and expectations. It's about acknowledging that life is unpredictable and building in that flexibility to adapt to whatever comes your way.
It's about building a financial plan that can weather those unexpected storms, allowing you to stay in the game, even when things don't go exactly according to plan.
And that resilience, that ability to endure and adapt, is what ultimately allows you to take advantage of opportunities when they arise and benefit from the long-term power of compounding. It's about creating a financial ecosystem that supports your growth and allows you to navigate the complexities of the financial world with confidence and clarity.
But even with the best plans and strategies in place, it can be difficult to stay positive and focused when we're constantly bombarded with negative news and predictions of doom and gloom. I'm curious to hear your perspective on this. Why does it seem like bad news dominates our perception of the financial world?
It's a fascinating phenomenon, isn't it? There are a few reasons why pessimism seems to have such a strong hold on us, especially when it comes to money. First, money problems are universal. It doesn't matter if you're rich or poor. Everyone worries about money to some extent. So stories about financial hardship, economic crises, and market crashes tend to grab our attention because they resonate with our own anxieties and fears.
It's like that old saying, if it bleeds, it leads. Bad news is often more dramatic and attention-grabbing than stories about slow, steady progress. It's also often more unexpected, which makes it feel more urgent and worthy of our immediate attention. We're wired to pay attention to threats and dangers, and financial calamities certainly fit that description.
Right. Bad news is often framed as a sudden, urgent problem that needs immediate attention, whereas positive developments tend to unfold more gradually and often go unnoticed. It's like we're so focused on the potholes in the road that we miss the beautiful scenery along the way.
And I think that can lead us to underestimate the power of long-term progress. Housel contrasts the media's eagerness to embrace those doomsday economic predictions with the often overlooked reality of long-term growth and innovation. Despite the inevitable ups and downs, the overall trajectory of human progress has been remarkably positive.
It's a powerful reminder to stay grounded amid that constant barrage of negativity. The world is not always falling apart, even when the headlines scream otherwise. Over the long run, human ingenuity, innovation, and resilience tend to prevail. It's about recognizing that progress isn't always linear, and that setbacks are a natural part of the journey.
It's a message of hope, of optimism, and a reminder that we have more control over our financial destinies than we often realize. But it's not just about ignoring the negative news, right? It's also about being mindful of how those negative narratives can shape our perceptions and influence our decisions.
Exactly. And that brings us to another important concept Housel explores: the power of narratives. He argues that the stories we tell ourselves about the economy can have a real impact on our financial decisions, and ultimately on the economy itself. He uses the 2008 financial crisis as a prime example.
Okay.
The economic fundamentals didn't change overnight, but the story we told ourselves about the economy did. Suddenly, fear and panic took hold, leading to a cascade of consequences that rippled through the entire system.
It's almost like a self-fulfilling prophecy, isn't it? Once the narrative shifted from confidence to fear, people started pulling back on spending. Businesses tightened their belts, and the economy spiraled downward.
And it's not just about crises. Housel points to the dot-com bubble as another example of how narratives can shape our financial reality. Back then, the story was all about the transformative power of the internet, and investors were willing to pay exorbitant prices for tech stocks, even those with little to no earnings. It was a classic case of irrational exuberance driven by a powerful narrative that ultimately proved unsustainable.
So how do we discern between a narrative that's grounded in reality and one that's just hype or fear-mongering? It seems like we're constantly bombarded with information and conflicting narratives.
Yeah.
Especially in the age of social media, how do we develop the critical thinking skills needed to navigate this landscape effectively?
That's a crucial question in today's world. It's about cultivating a healthy skepticism, questioning assumptions, and looking beyond the headlines. It's about recognizing that our own biases and emotions can color our perceptions, and that we should be wary of narratives that simply confirm our existing beliefs or play on our fears.
It's also about seeking out diverse perspectives, right? It's about being willing to challenge our own assumptions and being open to the possibility that the story we're telling ourselves might not be the whole picture.
You're right. It's about recognizing that there's always more than one side to every story, and that complexity and nuance are often lost in those simplified narratives that dominate the news cycle.
And that leads us to Husserl's final point, which I find particularly thought-provoking: the incomplete view. He uses this clever analogy comparing his one-year-old daughter's limited understanding of the world to her own incomplete grasp of complex financial systems. It's a humbling reminder that despite all our knowledge and experience, we're all operating with limited information and a finite understanding of how the world truly works.
It's a brilliant analogy, isn't it? It highlights the inherent limitations of our knowledge and the dangers of overconfidence. We tend to think we're rational, informed decision makers. But the reality is, we're all susceptible to biases, blind spots, and incomplete information. We make assumptions based on our limited experiences, and often fill in the gaps with narratives that may or may not be accurate.
So how do we avoid falling into the trap of thinking we know more than we actually do? How do we cultivate a sense of humility in our financial decision-making, especially when there's so much pressure to appear knowledgeable and confident?
I think it starts with acknowledging the limits of our knowledge and being open to different perspectives. It's about recognizing that we don't have all the answers and that the financial world is a complex, ever-changing system that we can never fully comprehend. It's about embracing that sense of wonder and curiosity, recognizing that there's always more to learn.
It's about being comfortable with saying, I don't know, and seeking out information from a variety of sources. Rather than relying on a single narrative or expert opinion, it's about being willing to challenge our own assumptions and being open to the possibility that we might be wrong. And I think that openness to learning and growth is essential to navigating the complexities of the financial world.
Absolutely. It's about recognizing that financial literacy is a journey, not a destination. There's always more to learn, more to explore, and more to discover. And that journey of continuous learning is what ultimately empowers us to make informed decisions, build resilience, and create a future aligned with our values and aspirations.
This has been such an insightful conversation. I feel like we barely scratched the surface of all the wisdom contained in the psychology of money. There's so much to unpack here, and so many valuable insights. to apply to our own financial journeys.
I agree. I love how Housel combines those practical financial tips with these deep psychological insights. It's a reminder that personal finance is about so much more than just numbers and spreadsheets. It's about understanding ourselves, our motivations, and the forces that shape our decisions.
So to wrap up this part of our deep dive, let's recap some of the key takeaways we've explored so far. First, be mindful of how your personal experiences and emotions influence your financial decisions. We all have a unique money story, and understanding that story is key to making choices that align with our values and goals.
Absolutely. And second, focus on building long-term wealth and resilience, not just chasing those short-term gains. Remember the power of compounding, the importance of saving consistently, and the need to protect your assets from unexpected shocks.
And finally, don't underestimate the power of narratives and the importance of critical thinking. Question assumptions, seek out diverse perspectives, and be wary of stories that simply confirm your existing beliefs or play on your fears.
It's about being an active participant in your financial journey, rather than passively accepting the narratives presented to you. It's about taking ownership of your financial decisions and creating a future that reflects your values and aspirations.
This has been such an engaging exploration of the psychology of money. I feel like we've covered a lot of ground, but there's still so much more to discover. Let's continue this deep dive in our next session, where we'll delve even deeper into the psychological factors that shape our relationship with money. As we've been discussing these different psychological factors, it's striking how much our perception of the financial world is shaped by the stories we tell ourselves and the narratives that surround us. Howell's analogy about his one-year-old daughter's limited understanding of the world really stuck with me.
Yeah.
It's a powerful reminder that we all construct narratives to make sense of the world, even with limited information.
It's such a profound insight, isn't it? We like to think of ourselves as rational, logical beings, but the reality is we're all constantly filling in the gaps in our knowledge with stories and assumptions. And those narratives, those mental models we create, can have a huge impact on our financial decisions, whether we're aware of them or not.
So how do we become more aware of those underlying narratives? And more importantly, how do we discern between a narrative that's grounded in reality and one that's driven by fear, hype, or our own biases?
Yeah.
It seems like a crucial skill to develop, especially in today's world, where we're bombarded with information from all sides.
It's about cultivating that critical thinking mindset we were talking about earlier. It's about questioning assumptions, digging deeper, and not taking things at face value. It's about recognizing that every story has multiple perspectives, and that the loudest voice doesn't always have the most accurate or complete picture.
It's like we need to become investigative journalists of our own financial lives, right?
Yeah.
Always asking questions, seeking out different sources of information, and challenging the narratives that are presented to us.
Exactly. It's about taking ownership of our financial education, not just relying on what we hear from the news, social media, or even well-meaning friends and family members. It's about developing our own informed perspectives based on research, analysis, and a willingness to challenge our own assumptions.
And I think that ties back to Housel's emphasis on humility, on acknowledging that we don't have all the answers, and that the financial world is far more complex than we can ever fully grasp. It's about recognizing that there's always more to learn and being open to different perspectives and approaches.
That's such a key point. It's not about becoming paralyzed by uncertainty or giving up on trying to understand the financial world. It's about embracing that uncertainty, recognizing that it's an inherent part of the journey, and using it as a catalyst for growth and learning.
It's about adopting a growth mindset rather than a fixed mindset, right? It's about viewing challenges and setbacks as opportunities to learn and adapt, rather than reasons to give up or become discouraged.
Absolutely. And I think that's one of the most empowering messages that Housel conveys throughout the book. It's not about having all the answers or predicting the future with perfect accuracy. It's about recognizing that we have more control over our financial destinies than we often realize. We have the power to educate ourselves, make informed decisions, and build resilience even in the face of uncertainty.
And that sense of agency is so important,
Yeah.
especially when we consider all the psychological factors that can influence our financial decisions. We're not just passive bystanders in the financial world. We have the power to shape our own financial futures, even if it's one small decision at a time.
And that's what makes The Psychology of Money such a compelling and valuable read. It's not just a guide to investing or managing your finances. It's a deep dive into the human mind and the forces that shape our relationship with money. It's a reminder that personal finance is about so much more than just numbers and spreadsheets. It's about understanding ourselves, our motivations, and the narratives that guide our decisions.
I couldn't agree more. This deep dive has been such an eye-opening experience for me. I feel like I've gained so much more than just financial knowledge. It's like I've gained a deeper understanding of myself and the way I think about money.
I've had the same experience. I love how Housel weaves together these practical financial tips with these profound psychological insights. It's a powerful combination that can truly transform the way we approach money and the choices we make.
So as we wrap up this deep dive into the psychology of money, let's take a moment to reflect on the key takeaways and how we can apply them to our own lives. What are some of the most valuable insights you've gained from this exploration, and how do you plan to integrate them into your financial decision-making going forward?
One of the most powerful takeaways for me has been the importance of understanding my own money story, those experiences and influences that have shaped my beliefs and behaviors around money. It's about recognizing the emotional triggers that might be driving my financial decisions and developing strategies to make more conscious, intentional choices.
I love that. It's about bringing a sense of self-awareness and mindfulness to our financial lives. What about you, listener?
Mhm.
What has resonated with you the most from this deep dive? And what are some steps you might take to apply these insights to your own financial journey?
Another key takeaway for me has been the emphasis on building long-term wealth and resilience. It's about shifting my focus from those short-term gains and quick wins to a more sustainable approach that prioritizes consistent saving, smart investing, and protecting my assets from those inevitable market fluctuations and life's unexpected curveballs. It's about playing the long game and trusting the power of compounding to work its magic over time.
It's about building that financial foundation that can withstand the storms and support your long-term goals and aspirations. It's about creating a sense of security and freedom that allows you to pursue your passions and live a fulfilling life without constantly worrying about money.
And finally, I think the discussion about narratives has been incredibly impactful. It's a reminder to be a critical thinker, to question assumptions, and to seek out diverse perspectives. It's about recognizing the power of stories to shape our beliefs and behaviors, and being mindful of the narratives we choose to embrace.
It's about becoming more conscious consumers of information, especially when it comes to financial matters. It's about developing that healthy skepticism and being willing to challenge the narratives that are presented to us, whether it's from the media, social media, or even well-meaning friends and family members.
It's about empowering ourselves to make informed decisions based on a solid understanding of the facts and a willingness to think critically and independently.
This has been such a rewarding exploration of the psychology of money.
Hmm.
I hope you've found it as valuable as I have, listener. As we conclude this deep dive, I want to leave you with one final thought. Remember, your relationship with money is a journey, not a destination. It's a continuous process of learning, growing, and evolving. So embrace the challenges, celebrate the successes, and never stop exploring the fascinating world of personal finance.
Well said. And remember, knowledge is power, especially when it comes to money. So keep learning, keep growing, and keep striving to create a financial future that reflects your values and empowers you to live the life you truly desire.
Thanks for joining us on this journey, listener. Until next time, happy investing.